My name is Assem. I'm head of the real estate finance, so I cover all the clients who don't speak German. All right. We have offices in Amsterdam, Paris, and Warsaw, and our international portfolio makes up around 30% of a 18 billion lending portfolio. The company is very old. We will have our 150th anniversary very soon, and we are specialized on mortgage-backed financing, so no corporate loans. What else can I say?
No, that's great. Yeah? Timo.
Yeah, Timo Tschammler, thank you. Jones-Lang LaSalle, I think, will be known to most of our audience here in Germany. We do operate with approximately 1,200 people, full-service country, so from facility management up the markets, corporate finance, and you name it. We are operating in Germany since approximately 40 years now. Cover the big seven, plus a couple of smaller cities. Metropolitan regions such as Nuremberg, Essen, and Mannheim are the newest geographical spread outs.
Okay, great. Andreas.
Commerz Real is the center of competence for real assets in Commerzbank Group. We currently have 32 billion assets under management, mainly real estate, but also renewable energy, ships, planes, infrastructure assets. We are basically real estate-wise investing all over the world. We invest from Honolulu to Sydney, so we are international with a clear focus on Europe, though.
Okay, great. Ralph.
Yeah, good morning to everyone. Ralph Winter with CORESTATE. CORESTATE is an asset manager, mainly driven for German-speaking countries, now on 20+ billion assets under management. Yeah, and I founded the company in 2006, and we went public exactly 1 year and 1 day ago.
Oh, was it exactly then? Wow, okay, well, congratulations. Good. I mean, and this started with an idea of looking at how the next crisis could change the real estate markets. I mean, maybe let's start with you, and Andreas. Are there particular things? I mean, the last crisis was a financial crisis. What do you think could potentially trigger the next one? Is that something that's in your planning? Not creating it, but...
Well, we all come from a cycle world, so everyone thinks this cycle we currently have has been going on for quite a long time, and it seems to be natural for everyone that a down cycle has to come eventually. Usually we prepare for risk we've experienced in the past. That's quite easy. If you know what you have had experience, it's good to prepare. What's very difficult is to prepare for future things you have not experienced before. And so I guess we all try to use our fantasy to imagine, could it be a political crisis? Could it be a euro crisis? What we discussed, could it be a liquidity crisis? What happens if too many people have too much liquidity and we drown in liquidity? What could that do to the markets? But currently what I always experienced in the past is that you need to have a group, which is usually a quite huge group of investors who get in a distressed situation, which forces them to put assets in the market irrespective of the pricing you can achieve at the current level. And that usually helps then to put prices down and put pressure in the market. And I currently can't see, if you look at Sony Center, which was just announced, Oxford Property acquired for 1.1 billion the Sony Center, which was quite expensive, but they used probably a leverage maybe of 50 or 60%, but I can't imagine what could happen that Oxford will be forced to put the Sony Center back in the market for 500 or 600 million, which would be necessary to have prices come down really fast. We have so much equity in the market. The financing banks are very conservative, or a lot more conservative than they were back in 2005, 2006. So the awful truth is that I don't have an exact answer what can happen. We try to be cautious. We try to clean up our portfolio. We try to prepare. We don't try to pay huge prices, no exaggeration. We haven't acquired anything for 30, 31 multiple, and I don't think we will do that. And other than that is be cautious.
Okay, good. And Assem, obviously, Andreas there mentioned that it was a banking financing crisis. Is the finance side now in a significantly better position, do you think, than it was last time before in terms of the crisis?
On a first level, of course, we see there's much more equity in the market, as you just rightly put it, and we're far from the leverages that we've seen before the last crisis. However, it would be an illusion to think that if there's a loss in equity, that this will be neutral for the whole economic system. So we are still concerned. I don't think that the banks will be in the trouble in the first place, but the losses have to be taken somewhere, and there's a sort of a closed system in capital flows. So where will it affect us? I'm not quite sure I have an answer at this stage.
Okay, good. I mean, Timo, in terms of you, there's obviously a lot of, themes in the market. You've got, for example, China's debt bubble, rising populism across the world in terms of politics, Brexit. You've got the end of the sort of quantitative easing from central banks. You've got a tick up in interest rates coming in the UK. What is it that you kind of see as potentially being something from any of those? Do you think any of those could create a similar situation? Do you see anything arising from those or a combination of them?
Thank you. Often people tell us that we are optimists by nature, being an advisor, and I have to tell you that's definitely not true. Actually, the opposite is the case. We are very sensitive when it comes to those pressure points, which might cause a turn in the cycle, which might cause an upcoming of a crisis. You asked for a couple of political impacts. We did a survey right before the election date in Germany amongst 100 investors from very different natures, from pension fund to insurances, public funds, and other institutional investors. And they ranked the potential impact of those impacts in the following order. The interest rate environment, definitely on number one. So you asked for it, so I would agree on that. That's a real game changer if we see changes here. Secondly, the Brexit was in the press yesterday and today that more and more Brexit-related lease contracts are now really and literally signed these days in Frankfurt, mostly Frankfurt, but first sniffing around Berlin, for example, as well. So Brexit on two, and then on the third place it was the election in Germany itself, which didn't have much of an impact, despite the result we witnessed. So that's the sentiment we observed.
Okay, good. I mean, Ralph, just coming to you, let's look at some of the implications maybe. And in terms of those sorts of risks, what do you think is most likely? Do you think it's most likely that there would be a kind of stagnation or a crisis or a correction? What do you think the impact on the market would be?
Yeah, I mean, I guess everyone, especially now, I mean, if you see everyone here is happy, if you see all the receptions in the evening, I mean, the sky's the limit. And honestly, I think that the sky's the limit currently, because if nothing really happens in a way of, let's say, a war or something comes, I guess we will see a certain sideways development over the next years. I mean, why not? I mean, we are still, real estate market in Europe is still in pretty good shape. I mean, if you see all the cap rates, we are currently having a look into comparing data from 2007 to today. And it's quite interesting. I mean, if you see that office prime rates, for example, are lower than they were before the crisis, approximately 1.5% lower. But what's interesting is that the interest rates as well are 3.5% lower as they were in 2007. So if you're going to calculate that, there's still an interesting arbitrage on that. So the market is still healthy. I don't see a bubble like that. I don't see craziness in providing debt. I don't see this super, I mean, even not in the US, I see any I mean, you don't see this crazy debt business, what we had before. So, I mean, there's a lot of product in the market. And on the other hand, if you see and if you talk to foreign investors, they are still comparing Germany to other to other European cities or to global cities. So the price range is still okay. And let's say, as long as the interest rates are not rising that much, which I personally don't believe will happen, Germany can definitely digest higher interest rates. Why not? Everyone says, okay, when the interest rates comes up, you know what happens in the US, and I'm definitely sure that this will not happen that quick, and it will not rise that much as what we've seen in the US. And the US market's pretty there. Nothing happened. So why? We can live with a little bit higher interest rates. Why not? This will not destroy the market.
Andreas, I wanted to pick that up. If that's not going to destroy the market, you mentioned already the amount of liquidity, and as did Timo, in terms of the market. Does there become a potential issue from that if there is so much equity chasing product that it begins to move investors to a much more risky place in terms of their investments to achieve the same returns? What's your sense of that, or do you think the market is still relatively sensible in terms of how it's approaching that task?
Well, what you always see is that people go into B and C locations or B or C cities or EBA strategy or whatever. For us, we are core investors, so what I currently experience is that the pricing the market has in, let's say, Berlin again, we with our products are not able to pay these prices. We have our costs, we have a certain performance our investors expect from our products, and if I acquire for 3.0 and I deduct the natural depreciation because of transaction costs, and if I deduct my costs, and then if I have a natural depreciation in office, you need to write it off a little because an office building is brand new at the beginning, and in 10 years it's 10 years old, and usually times have changed and technique has changed, efficiency has changed, sustainability has changed, and you need to invest a lot and you need to put some money back for that. And so if we're acquiring with usually zero leverage, I have to say, we usually don't use leverage because we have so much liquidity, our investors end up with zero. And the equity story for your investor to say, I acquired an asset for 1.1 billion and your return is zero, I don't think that really sells. And so the awful truth is that at the current pricing, we're out of the market for core investments, and our strategy is not to move on, then do value add or opportunistic or go in cities where we haven't been before. So what we have to do is to go out in the world to use our advantages with regards to leverage, to financing, to tax structures, to use the same advantages. If you look at Oxford Capital, they use currency advantages, they use diversification advantages, they might even bet on the euro, then they have very cheap financing facilities. So as an international investor, you can acquire for 3.0 in Berlin. We as a natural investor, as a local investor, we can't do that.
Okay, yeah, pick that up.
Let me please add one thing here to what Andreas is saying. We often hear that there's not enough product, and that's a limiting factor in the market. On the one hand, we do see an investment volume this year in Germany somewhere, depends on where we land in the fourth quarter, between 50 and 55 billion of total transaction volume. On the other hand, if you look at the demands, which cannot be materialized through successful acquisitions, that's much higher. We get, just to quantify what it means in this balance or disbalance, we get around 8 offers per sale we bring to the market. So this doesn't mean that you can take the current volume times 8. Yeah, it's not that simple, but it gives you a feeling for the pressure which is there. And then looking at the dilemma Andreas just described with the new price levels and record yields which we are witnessing across most of the asset classes, a lot of institutional investors looking at their statutory minimum interest they have to generate and yield they have to generate, they are simply out of the game because it got too expensive. So liquidity is pushing, while you have a price level, a new price level, which is second to none and has not been seen before, which just takes out the chances on top of this pressure and eliminates some of the usual suspect institutional investors, which were the most active buyers in the past.
Okay, good. Feel free to pick that up, Assem, but I'd also like to pick up the point that Ralph made there about interest rates, that the market can afford a normalization of interest rates. But how do you see that from the financing perspective? Would that create issues for some of the lenders, or because of the leverage, is it less likely that the banks will be in a problem, but actually it could be the investors who might have to take a haircut?
Yeah, absolutely. I would agree to a certain extent to your statement, but not with everything. I'll come to that.
That's what we like, a bit of disagreement, Assem, yes.
Yes, I know. I'm doing you a favor there. But I agree that the market can absorb to a certain degree rising interest rates. Not everybody, but most of the investments we see will be able to afford, let's say, 1.5% higher interest rates, I think. There will be investments with tighter yields where that will be a wholly different story, but the average investment will be able to afford that. Now, coming back to your statement, you showed us the sunlight, and I'm going to cast some clouds and shadows on market. I think I'm asking myself if at cap rates of, let's say, 3%, I think you mentioned average prime yields at 3%, is the inherent risk of real estate reflected? Is there a risk premium in there? And when we talk about risk, let's name two risks, which is, first of all, the liquidity risk, that big investments such as the one we saw in Berlin, but also elsewhere, might not have the same market reception in other times. That's the first question. And the second question I ask myself is the increasing correlation of markets not inherent risk of our markets, and shouldn't we put a price tag on that increasing risk?
Do you want to pick that up?
I mean, look, if you see the market today, and if you're talking, let's say, I mean, where does the big demand come from? In Germany, we haven't seen that much institutional demand for the last years. That came up now. Why? Because they don't have any alternatives. So having said so, they go in with a very low debt, and at the end of the day, it's really not a big difference whether they buy into a cap rate by 3.5 or 4. I know you will not agree to that, but at the end of the day, this is not the end of the world. It's exactly as you were saying. I just read this morning, prime logistic asset, 4.5% cap rate. Oh my God, 4.5%, that seems super, super low. So years ago, that was approximately 6 or 7. So coming back to that, but that is the reflection of risk. Risk, in my opinion, means, and I'm much more scared about the liquidity is not coming in. You know, when that happens, we have a real problem, because that's all about where the demand comes from. But if you see now the last days or the last weeks, then especially if you see it from foreign countries, Germany is super stable. Look what happens in Spain now. Look what happens with the Brexit. You know, Germany is the most stable nation we know. I mean, look what's going on in the US. You know, all the US investors are looking back into Germany now. Everyone is super excited about, maybe not retail, but they go for German office, they go for logistic, they go for residential. You know, if you see, and that's a big, that's very, very interesting. And on the other hand, don't underestimate, we have 3.3 trillion saving money from savers lying on Sparkassen accounts. After inflation, there's nothing left. So where's the alternative to real estate? My concern is all the buyers today, they have to figure out how they're going to manage the assets, because currently they just buy into. The next crisis, and I'm happy that we're with CORESTATE, because CORESTATE is an asset manager. We as not a heavy balance sheet company, you know, we're gonna help managing the assets. I guess this will be one of the challenges, especially because there are some players going into it with huge amount of money investing into real estate, which normally do not have any clue about real estate. So this will be something of the challenges. But I don't see that. I mean, I can only tell you all what we've done over the last weeks, very positive. Germany came up tremendously. Nearly, I mean, super low unemployment rates. I mean, what you want to argue, it's all perfect, yeah?
Did you want to pick that up, Andreas?
Yeah, I'm glad. I mean, you're the host of this panel, so I'm glad that you're glad. And most of the things you said, I would even agree to. I guess the awful truth is that our business model as Commerz Real, for example, is heavily affected by the current pricing. We used to be at the beginning of 2000, open-ended funds were basically the only ones in the world who were able to buy assets at a value of, let's say, 1 billion euros. We were more or less alone on the planet, and people were always amazed about these open-ended funds from Germany, which acquired 80% from Amsterdam and which acquired many assets in the US. They owned half of Paris. And what you nowadays see is that Norges, that Oxford, that sovereign wealth funds, other institutional investors, insurance companies, they actually copied our business model, and they do direct investments, and they say, I don't need a Commerz Real anymore. And so the people who need us are the smaller institutional investors who don't have their own infrastructure, who don't have their own acquisition teams, and the retail investors who want to invest in office buildings or in shopping centers, which they obviously can't do with their own funds. But what you see, and there we are again, unfortunately for our clients who want to do business with us, we currently hardly find asset in the risk class we want to, we promise them and we want to acquire. So for us, it's a threat on the business model, and for the real estate markets, it's perfectly fine. But I'm here to talk for Commerz Real, and we have 700 people, 750 people who have their jobs with us, and so we need to find out what do we do. I guess one correct answer is asset management. You can achieve a lot of performance through active asset management. We do refurbishments in our portfolios, enlargement in our portfolios. We have in-house invest close to 13 billion, and we are investing roughly 1 billion in our existing portfolio this year, so that helps. To bring up your occupancy, that obviously has a huge impact to sell off assets in the current market at prices you hadn't dreamed of a few years ago. So I guess there is a lot of work to do, but if this continues to go on for the next 3 years, we have a severe problem in our home markets to invest in core assets.
Okay, good. And Timo, maybe just pick that up. How many other funds are in a similar kind of position where the level of pricing at the moment is an issue, and where they may have to change what they're doing in order to meet the market if it continues at this level? And the other sort of second part of that is, Ralph there mentioned some of the sectors, I think. If you begin to see some kind of crisis return, are there sectors that will be safer? Are there sectors that will be potentially more badly burned? I mean, I'm interested in, for example, which have grown quite a lot recently, student housing, but has been very successful. Are those the kind of areas that maybe get more difficult because they're more reliant on operational risk? Or what's your sense of the sectors as well?
All right. So to answer your first question, how many other funds are in a similar situation? I don't have a statistic to hand, but I can assure you it's a majority. And what those funds then do, I mean, they have three alternatives, right? They could give back the liquidity, which is a very unlikely option. They could adjust.
Andreas doesn't look as though that's an option.
So that's unlikely. Secondly, they could adjust the risk profile. That's something we do witness clearly. Yeah? So going from core plus, and so on down the ladder, up the risk ladder actually, and they shift into other sectors. So that builds the bridge to your second question. And if you look at the percentage of growth within alternative sectors, hospitality and health was one of the winners over the last, I would say by now 6 quarters or so. And even what we heard earlier, the new prime yields in the logistics sector. Logistics is going through a renaissance. Was the first portfolio deals after the financial crisis, the first portfolio premiums we saw there, the heaviest yield compression, which is still continuing. I mean, the 5% mark has been overstepped is only a couple of months ago, and now we're talking 4.5. So that's continuing. And alternative sectors and asset classes do attract fresh money and do attract conservative money looking into those sectors now. And I think then to answer your last question, so which sector will suffer first, that's a tricky question because in there you have sectoral changes. I mean, look at what's happening these days to high street retail, which is under pressure, where the rents are under pressure, where a new disruption and competition in quotation marks online trade from digitalization. You can't ignore this in here. And on the other hand, maybe we are witnessing these days new trends if you think of communities and co-working elements which do push into that as well. So maybe it's a cyclistic moment and wider mood and performance of the economy. Maybe it's the beginning of a new mega trend. So still to be witnessed.
Okay, good. And Assem, obviously one of the about attractiveness. I mean, and Ralph talked about it there earlier, which is the attractiveness of real estate as an asset class. But how much of that is linked into the difference, you know, the yield gap between bonds, I mean, government bonds based on the interest rate, and real estate? And if we do see a tick up in interest rates, and we see still pricing getting higher in terms of the real estate market, do we then begin to get into a potential issue there?
That's a tough question. That's a question for those guys because we're only a company. They have to take the decision.
But you'll be deciding on who to lend.
Exactly. That's true. As I said before, I think Muschter said that they hardly find products with the right risk profile, which answers sort of my question: is there an adequate risk premium in the market? So if yields go down still further, and we have a rising interest rate environment, I think things are going to get tough to make things work out economically in a sensible way. Wouldn't you agree? I mean, it's if we're talking about yields of say 7-8%, there's no issue in that. But if I talking about prime yields being somewhere around 3% and that's dropping to 2.5%, now you do have difficulties imagining how you're going to make the economics work.
Okay, good. You mentioned, obviously, that you don't see the liquidity bubble bursting because there's, in terms of the real estate sector, I mean, traditionally, it's things like military strikes or those kinds of things which are completely outside the sector that act as a trigger. Is that something that concerns you in terms of when you're looking at investment strategy? Are there things like this that potentially you see could come up and might trigger a crisis in that sense?
What the ECB is doing, and I mean, you see that. I mean, of the day, Draghi has rescued the euro. We see quite. I mean, even another one. It's quite hard for Germany to step out of that quantitative easing moment. So even if we do that in very low steps, as I said before, it will not kill the market. You know, it will be clear that there will be less liquidity. But what is the alternative? I mean, what are real alternatives? I mean, we're looking for all different kinds of needs. I mean, we started, for instance, student housing very, very early. I would say we were one of the first one doing that here. It was 6-7 years ago. We started with a very small. Today, student housing is an asset group. You know, so I mean, let's think about it. What I guess is the thing in that super party here is the talent is not really working on new ideas. What are the new ideas? You know, we are all running in this normal office stuff. We are running, doing some resi, whatever. But what are the new niches? I mean, what are the really good lines for the next 15 years? And the community changes a lot. You know, we see that in Germany. We see it from other countries. So we have to be more creative. Real estate is not a very creative industry. You know, if you see, I mean, even if you see now all the fintech, proptech, all what is coming, it takes a long, it's quite slowly coming. If you're going to compare that to the US, investors invest 50 times more venture capital into proptech as what we do in Europe. This will just be the beginning of it. I mean, everyone talks about it, no one knows anything about it. You know, and I mean, is it me as well? I mean, by the way, we're just, you know, going into that, trying to better understand. But I guess we have to work on that. I guess it's not a good idea always to say, okay, what can be the next prizes? The next prizes will come, by the way. Something will happen, and we all stand here that, oh yeah, you're right. I always said there will be something. By the way, it's super easy to say something is coming, because the negative things will always surprise us. So just talking about, I mean, look, when we started, we were only 6 people employed. Today, I guess we are 470 plus, and hopefully we will get more. I mean, let's be more creative. Let's be more looking for talents around, and let's look how we gonna master that, you know. And I guess that's. I'm a little bit bored about only discussing what can be the next crisis. Honestly, no one knows, you know.
I mean, it's quite interesting also, and this is for anybody really, it's just noticeable that a lot of the things that have come up in terms of political risk, there was a huge amount of discussion about that with Trump, with Brexit, with many of those things, but the stock markets don't seem to have been hugely impacted by it in terms of, and do you think, in a way, real estate is just as stable and that there is still got to be investment capital coming in, and so it's difficult to see what's going to impact on it in the same way if stock markets can continue, why not real estate? Does anybody want to pick that up?
I don't have the numbers at hand, but I would assume that we have a lot more capital and in particular equity in the market than we had 10 years ago. That obviously helps that there are so many people, there's so much liquidity in the market which hasn't been there before. Many institutional investors have increased their real estate quotes, and so they're allowed to invest up to 50% of their daily or yearly net inflows in real estate. There are huge amounts which push in the market every year. It's not only about selling or disinvesting, it's also about new investments. If you have 2 billion net new money every year and you invest 15% in real estate and then you put leverage on top, you have huge numbers to invest every year. And there are so many big pension funds and sovereign wealth funds who are in our markets. And you see that in the stock markets as well. It's amazing to see how stable the prices are and how stable the DAX and all international indexes are, just because the people don't know where to go. I mean, that's always the same issue. Where are we supposed to put our money? And if you don't have an option, and if you see that over 10 years stock has always won, you over the full cycle of economy, you always see that stock gain at an average of 4%. So if you buy an ETF or if you buy in certificates, you will, over the 10-year cycle, you will always make money with stock, even though if the markets go down a little. So I can see why people stay in there, and that applies for real estate as well. So that's the same phenomenon we see in the real estate market.
Okay, good. Did you want to pick that up, Assem?
Yeah, just to comment on the side, concerning the discussion about political risk, which I hear as a leitmotif very often. I think we have to acknowledge that the markets don't care if we've got perfect democracies or not. What they do care is about uncertainty or do they know what the next tax legislation will be. And that's, as long as we keep in a stable environment in that sense, those markets will function very soundly.
Okay, good. And Ralph mentioned prop tech, and absolutely right. What's happening in the States is fascinating in terms of their ability to invest. But in terms of there's a lot of fintech going on as well. There's cryptocurrencies. There's all of these things coming around. Does that pose a risk? I mean, not just for you as a bank, but in general, do you think that's a market element that's moving very fast and could get out of control, or is that just more about creating more transparency, actually more safety in the market?
Well, as you might know, we embraced that challenge quite actively recently and invested into a fintech. We took a share in the Brickfast platform. We see that proposal as complementary to the traditional banks for the time being. We don't underestimate the threat that could potentially arise from that to traditional business models, and we are a traditional business model still. But we think that we have to evolve with that and think about how we're going about the business. Access to capital, may it be equity or debt positions, will be easier through digitalization, I think. And we have to face that in the inevitable. And we're trying to be part of that evolution.
Okay, good. Timo, I wanted to pick one thing up from you, which kind of follows on from Andreas's point as well, which is about fund models. How do they work if you're in that kind of situation where it's difficult to invest? Does that mean that you're going to suddenly have a position where you will get smaller, much more specialized funds beginning to come in to access the sort of opportunities that you were talking about that are maybe either to do with widening the net of the types of investment or looking at more niche areas?
I think widening the net is something we do see already. So the established investment and fund managers, they come up with new vehicles. They come up with a couple of, let's say, trend followers. So if B cities and university cities perform well, it doesn't take long until you see the first funds which do only that, or which only go into south of Germany or whatever. You know. So I think that's quite a classic. And then you also have new, let's say, speedboats who enter on the sides. Who come in partly with a lot of help of institutional money. So you see club deals here, you see separate accounts quite often, and I think some of the public funds which did suffer from the liquidity crisis of the past and the meltdown they experienced, they were looking for their personal hail in such new models and new partnerings with the sovereign wealth funds of these worlds and others.
Okay, good. And one of the things I also wanted to touch on is in terms of de-risking, I mean, coming back to the earlier question in a way about are we in a different position now as the real estate market created? Either that's through, there's been sensible regulation, or that maybe the markets are less frothy than they've been before, and actually investment is more restrained to some extent, lending is more restrained. Maybe starting with you, Ralph, just in terms of your business and how you perceive risk, what do you do to minimize that risk within your investment strategy to avoid the potential issues if there is some form of crisis, so that you're better positioned?
Yeah, I mean, I guess one of the points is definitely what about the debt? What happened with the debt levels? I mean, if we see more this value add and opportunistic stuff, by the way, which we don't see in Germany any longer, or just very rare, just some very little situations, and you're gonna leverage it up to an 80 or 85 as it was in the past. That's pretty. I mean, this could be risky for the future, So I guess if you're gonna go for 60, 65, and would receive the more conservative one even below 50. I mean, what else? I mean, if you do residential, you have there's not a lot of tenant risk. Commercial, we talked about office. I guess office is coming up. I mean, everyone is now really interested in a lot of foreign demand. I mean, if you see the fundamentals in Germany, as mentioned, that looks quite good. Logistic is the upcoming star, is quite expensive overnight. Everybody wonders about what's going to happen there. I mean, it came a little bit along with the negative impact on the retail, and talking more about the Amazon stuff, what they're doing in logistic and all that kind of new storage. But yeah, I mean, it's more broad. I mean, I guess it's good if you. I mean, the question at the end of the day is, what did we learn about the last crisis? And I guess the learning is an interesting thing. I mean, there are some guys who didn't learn anything because they weren't even not there 10 years ago, which is not that bad, by the way, because these guys have new ideas, very open, very fresh-minded. So, I mean, we went through that. It was a hard time for most of us. And by the way, I mean, the manager getting paid to invest into real estate, only 3% of them really protect in a way of being super safe. And normally they get fired, by the way. Because if you have raised a fund and you're not investing, especially now, investors don't like that. So it's I mean, that's, I don't know, maybe you can add some very good protection lines. I would be happy to know about.
Well, maybe from an investor's perspective, obviously pricing is very important. You need to be careful with the pricing. If you pay too much, it's very hard, irrespective of how good you are in asset management, to have a positive investment. That's one point. Is as interesting as the first one. That's the location. Obviously, what you always experience is if you are in top locations, you usually lose also money, but you don't lose as much as you lose in B or C locations, which is totally fair because your yield is a lot higher in B and C location, and that's because your risk is a lot higher. I mean, that's as boring as the first point. I guess what we currently do is to work on the costs, to work on our costs, to work on the cost of asset management, to work on the cost for our tenants, to be more efficient. We work on flexibility of our lease contracts. If you look at WeWork, they have a concept to bring a lot more flexibility in the portfolio. And I think if you have premium locations, if you have premium assets, there's always a demand to move into these buildings. So I don't see why I always need to look for a tenant who signs a 10 or 15-year contract, because that keeps me from riding the cycle on the lease prices as well. If I'd be more flexible and if I had year lease contracts, that would be a lot easier to react. In Berlin, for example, we'd love to have yearly contracts, and you come into new discussions with your tenants every year, and then you probably talk about increasing prices and not decreasing prices, whereby, let's say, Frankfurt 2 or 3 years ago with 10% of available office spaces and lots of project development coming up, there you seem to have an advantage with a 10-year contract, and you can calm down a little and say, okay, for the next 7 years at least, I don't need to work. So that is something to create more value out of asset management, flexibility, cost. That would be one point, and at the end, it is location and pricing.
Okay, good. Yeah.
Yeah. Well, you mentioned debt, so I'm going to respond to that. I think I'm always ready to be very critical about my own industry, but at this point, I have to say that banks, lenders have been quite disciplined in terms of managing the exit risk of a loan. There's apart from there being enough equity in the transaction, there's also very often enough amortization, and lenders do push back profiles that they cannot cope with, and especially when you look at the yield on debt, they've been quite disciplined. So that's a positive point, and I'm always surprised to see when we push back clients, no, we cannot do this. They go back into the market, and quite frequently they come back and say, okay, I didn't get what I asked for from any lender, so let us pursue the talks. So that's, I think, a good sign that there are healthy mechanisms in the market. The investors are not overly greedy in terms of protecting or being too greedy on their equity. So, it's for the time being, I'm quite optimistic when it comes to the debt positions in the market.
Okay, good. For everybody who's been listening very quietly to this, I just wanted a quick straw poll. In terms of raise your hands if you think real estate will sail through the next crisis, if there is one. Okay, we've got some. Okay, good optimism. I like that. Who thinks there's never going to be another crisis? Okay, so we all believe your point, Ralph, that there will be one, and we don't know what it is. Yeah. Does anybody know what the next crisis will be? No, again, you're correct. Good. I've just got one kind of final question, because I'm aware that we're kind of running short on time, which is, in terms of the impact of any new crisis, there are always opportunities that it brings as well. Do you believe that the real estate market is much better positioned, and do you think there will be opportunities that will come out of this because of the lessons that we've learned? Let's maybe start with you, Assem.
Well, as you know, we were in the last crisis, we're in an atypical situation. We had some issues before everybody else had. So when everybody did stupid things, we were not able to do those stupid things, which meant that we had a healthy balance sheet and a healthy economic situation when everybody was struggling. Of course, we made very good business at that time, and it's always better when you're driving on a sort of intentionally, or in our case with a little bit of luck, in an unintentionally on an acyclical activity. I think if things get rough, this time we're in the same boat with many other lenders. What we are doing though is we are putting aside money into our reserves so that we can sail through that crisis or that correction, let us put it this way, in a sound manner. And I think that's what conservative actors in the market all are doing at the moment. I hear that large funds are not investing, but they're leaving up to, I heard a number of one fund leaving $12 billion on the sidelines and just waiting.
And interesting also that despite all the concerns from London, at the moment, German funds are heavily investing in London, interestingly. So are there opportunities? Do you think we're in a safer place, and do you think there are opportunities that will come?
Just to pick up on the London investment market effect of Brexit, right now London stands before New York City as an investment destination. Just changed, has been on number 2 for many years, but as a matter of Brexit attracted investors moving in, and Germans are amongst the leaders. That's quite an effect. So I believe that the real estate market would be better equipped than last time if a crisis arises for 2 main reasons. Deleveraging. So LTVs are lower, as we all know. On the other hand, we have to ask ourselves what hurts more. If finance is burned, if banks' balance sheet are hit, or if it's the equity which comes out of pension schemes and so on. So I think that's going to be an interesting discussion if it happens. And the second and last reason from my point of view is the fact that behavior and decision making is more diligent than, let's say, 9 or 10 years ago. We don't see a lot of shots from the hip, a lot of stupid behavior we do not witness.
Okay, good. Andreas?
Well, I tend not to agree with Ralph to say that we're not trying to change or invest in developments and to be more creative, but I guess he is right that real estate is still a boring business, and I guess a crisis would help us to really reinvent real estate in some points. Change management always needs the necessity for a change. If you have perfect times, perfect cycle, then obviously most of the people are rather reluctant to change because they say we have so much work to do, and why do you start to digitalize our processes, or why do you talk about automation, why do you talk about cost cutting, why do you talk about new concepts of asset management, why do you want to change all these things? We are making the most money we've ever made. And so I guess the good part will be that if there is a crisis, I guess economically we are better prepared, the banks are better prepared, we are better prepared, but we will have cost pressure, we will have digitization pressure, and that will change our culture, that will change our community. Regulation will step in. I guess a little more regulation would probably be helpful to prevent us from some stupid transactions where the investors don't really have any advantages except for the advisors and the asset managers. I guess that's not the purpose. So every crisis has a good point because you start over again and you change things you should have changed before.
Okay, good.
Yeah, I guess the whole real estate environment, especially here in Germany, we developed well over the last years, I guess. What is still missing, in my opinion, if you're going to compare that to other countries, Germany, for instance, is totally intransparent on pricing and everything. You don't know what, in the US, for instance, you have a lot of more data available, let's say about residential or whatever. Here you see press releases or some of the deals which going to get where you see into it. But it's quite intransparent, which is good on one side, but which makes it difficult on the other side. And I guess, what we've learned over the last years, real estate, even here in Germany, is a global play. Especially foreign investors, we have to be compared, or we have to suppose that we're going to get compared with other countries. Let's say, a global investment manager compares the diversification of the portfolio. He's going into Brazil, whatever, Latin America, and then he sees Germany, Europe. So, we have to play more global. We have to see also the managers, I guess for instance, for us as CORESTATE, it's a big challenge to get talents in this market. It's quite hard, and they are all very well paid, maybe overpaid, you know, I would say so. But that's, so I guess we're well prepared, whatever comes, and yeah, I guess we will have a good future, all of us, definitely.